bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the February 18th, 2025 episode. This is our latest installment in the Renewable Energy Tax Credit Finance series. As our audience on YouTube can see, my guest this week is Tony Grappone, a partner in our Andover office. Tony is one of Novogradat's leading experts in renewable energy tax credits. And I'm particularly thankful that Tony is on the podcast right now because we are in the midst of tax season. And I know Tony is very busy, but we have a lot of good information to share with you today. So Tony, thanks for making time. Today, we're going to recap renewable energy tax credit financing and structuring trends from 2024. In the course of the podcast, we're going to discuss the types of structures that Tony and others at Novogradac are seeing, the types of technologies that were the most popular in terms of financings. We'll also talk about average portfolio sizes, various investor types, any shifts in investor pricing that Tony's seeing. We'll also discuss average investor returns, and we have a lot more we want to cover, but it's really a look back at the last half of 2024 as to what the renewable energy tax credit finance market looked like from an accountant's financial advisor's perspective. There's a lot to cover there. So if you're ready, let's get started. Tony, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's great to be here.
And once again, I thank you for taking some time out of your day of working on all the financing transactions you're working on, as well as the compliance work. But before we get started, please do describe the services you provide to Novogradac clients with a focus on the services in the renewable energy space.
Great. Yeah, thank you. So I think most of our listeners know that I oversee 3 silos of services from tax, audit, and related consulting services. There's 2 services, though, I just want to kind of highlight for our listeners today. One would be our prevailing wage and apprenticeship documentation services that we offer. We offer that through what's called a agreed upon procedures engagement, and that's been a very popular sort of new emerging service that we focus on. And then I'd also like to just highlight the financial forecasting services that we offer to help clients when they're trying to structure and finance deals.
Great. Thank you for that, Tony. I am really excited to dive into today's topic. I'm excited every week, particularly when you're a guest. But I know that you and our other Novogradac partners working in renewable energy, we're getting questions all the time about general market and structuring trends. Clearly, clients come to us for all of our technical expertise and the like, and the various services you already described that you provide, but also that broader industry knowledge is a great benefit for clients, a benefit that they really don't pay extra for. So in this episode, as I noted in the introduction, I want to be focusing on what you're seeing out there, you and fellow Novogradac partners. And I thought a great place to start is types of structures. In the renewable energy, there's a variety of structures that are possible. Other areas where we practice, like local building tax credits, don't have a wide variety of structures in a more general structuring sense. They obviously can have within each one some more modest structure, but not as significant, I think, as in the renewable space. So please take a moment to describe the various structures that were the most commonly used in 2024.
Great. Yeah, thanks, Mike. So right, the firm works on a lot of renewable energy tax equity financings every year. Recently, I analyzed a sample of over 50 of those financings that took place during the last 2 quarters of 2024. The structures included in this analysis represent partnership flips, the partnership T-flip, and the inverted lease. The sample I analyzed did not feature any of the what I'll call the pref equity partnership structures that we're aware have been used by a number of developers. I may start including some of those transactions in my 2025 analysis, but for 2024, again, the structures included in that analysis are the traditional partnership flip, the partnership T-flip, and the inverted lease.
So tell me how popular each of those 3 were.
Okay, great. So now let me just also point out that if any of our listeners want more insights on these various structures, I'll just remind folks that last year, you and I did a podcast that kind of broke down the details and nuances of each one of those structures. So if you want more insights on those structures, I encourage listeners to go back and tune into that old podcast that we did. Now, in terms of the structures that were used as part of this analysis that we observed, over 70% of the transactions featured the traditional partnership flip. Approximately 10% used what I call the T flip. And the T flip is a partnership flip transaction whereby the partnership elects to transfer the tax credits. Okay. So we had 70% that were traditional partnership flips, where it appears as though the parties are not going to transfer the tax credits. Around 10% of the structures featured the T flip, and then the balance, roughly 20%, used the inverted lease. Now, one important thing I'd like to note about these results is that all of the traditional flips that where they closed as just traditional flips, where it didn't feature a transfer as part of the original closing, each one of those operating agreements did have language in them allowing the partnership to ultimately elect to transfer the credits. And my understanding is that many of them will ultimately elect to go the transfer route. So when I say only 10% were T flips, that means that as of the time of the tax equity closing, the parties had already identified a tax credit transferee. And when I say that 70% of the transactions appear to be traditional flips, really what that means is that as of the time of the tax equity closing, a tax credit transferee had not been identified. I'll continue to monitor these deals in 2025 to see if the traditional flips ultimately opt to go the transfer route. And I also want to point out that the inverted lease cannot make an election to transfer tax credits. And again, just to reemphasize, the sample did not include any of the pref equity structures. However, under that structure, I'll just point out that in the pref equity structure, the partnership usually elects to transfer those credits.
Right. Thank you for that, Tony. That's really interesting, particularly the partnership flip, as we had discussed in prior podcasts. And I will, by the way, link the earlier podcast in today's show notes to the further discussion, explanation of partnership flips, T flips, and inverted leases. But I do find it interesting that of the partnership flip structures, the fact that they all had the transferability as part of it seemed like optionality. Why would you not want optionality? You never know what the future holds. The fact that the expectation is that large portion will ultimately transfer the credits, I find very interesting.
Agree. I do too.
So now, in terms of those structures, I'm also would like to know what your experience was with those 50, approximately 50 transactions, the percentage of solar versus battery storage systems versus other technologies. What was the makeup of those transactions?
Right. Great. Right. So the sample of deals, one thing I just want to point out is the sample of deals I looked at, it definitely says a lot about the types of transactions our firm works on. I don't think it's necessarily a statement about the entire renewable energy market, but it clearly gives you insights in terms of what our firm works on. Okay. The sample of deals that I looked at, or the portfolios I looked at, featured solar only on around 80% of the transactions. Standalone battery storage, just under 15% of the time, and solar combined with storage, approximately 5% of the time. And then after that, we have a very small number of deals that are sort of outside the solar or battery storage, clean energy technology area. And so in terms of technologies like, wind, biomass, fuel cells, hydropower, geothermal, et cetera, we do work on those technologies. They just make up a relatively small percentage of the overall deals that we see in the marketplace. And we think that is also sort of indicative of the broader market, but I'm just saying in terms of what we work on here at the firm, it is definitely solar, battery storage, and combination of solar and battery storage make up the overwhelming majority of the transactions here.
And how is that different than, say, 5 years ago?
Great. Right. So 5 years ago, we were still in the pre-IRA world. And pre-IRA, standalone storage wasn't eligible for the ITC. And therefore, an even greater percentage of the transactions we worked on were solar. These days, these days, since the IRA was passed, standalone storage can qualify for the ITC. And we've seen a really significant increase in the number of transactions that are just purely standalone storage. So that's probably the biggest takeaway is how much standalone storage has really grown in the marketplace.
And I don't know if you have these statistics readily available, but I know it's part of when you had done some of the analysis. Roughly how much total project costs were in these roughly 50 or so transactions? And just in order from a scale perspective, because there's a lot of talk about what is the size of the equity market and things of that nature. But if you're just to say the total project costs associated with this subset of, it's not even all the transactions you worked on in 2024, but it's a subset. Kind of how much are we talking about?
Okay, thank you for asking this. I've spent a lot of time analyzing the deals that our firm works on. And so, I looked at a sample size of, over 50 transactions. That does not make up 100% of the transactions the firm works on. We work on far more than that. But just in this sample of over 50 deals, we're talking about over $12 billion in CapEx. Of that, over $9 billion is from solar and close to $2.8 billion in standalone battery storage. And in terms of tax equity investment dollars, we're talking about an aggregate here of this entire sample size, roughly $4.6 billion of tax equity investments. And that's not even 100. And again, this represents, maybe half of what the firm works on, maybe not even half of what the firm works on. So it's a significant share of the market, no doubt.
No, and it just shows you the magnitude and the impact the Inflation Reduction Act has had in terms of driving investment. Because obviously those were the numbers 5 years ago.
Right, indeed.
So mentioning the Inflation Reduction Act, one interesting aspect of the Inflation Reduction Act when it was passed is looking to the future, there was going to be this transition to technology neutral tax credits. Or said differently, the amount of tax credits, your eligibility for tax credits wasn't a function of the actual technology, solar, wind, and the like, that your ability to claim a tax credit was a function of the facility producing electricity with zero greenhouse gas emissions. And, when the Inflation Reduction Act came out, we were thinking, okay, that's off into the future. Well, the future's now. And that switch happened as of January 1, 2025, where projects that are placed in service, January 1, 2025 or later, subject to transition rules, now fall into these technology neutral rules, or these tech neutral rules. What are your expectations when you think about all the transactions that closed last year? I know a number of transactions, were closing last year to safe harbor into the old rules. Now that we head into the tech neutral tax credit world, what are your sort of observations about what impact that might have in terms of the technology mix?
Yeah, exactly. So, my expectation is that for 2025 and probably even into a good portion of 2026, most of the clean energy transactions that get financed and the facilities that get placed in service my expectation is that most of those facilities will start a construction prior to 2025. And therefore they'll be looking to claim credits under the pre-tech neutral tax credit rules. And we likely won't see many tech neutral credit transactions or facilities until probably some point in 2026 and beyond. So whenever you've got these sort of like changes in tax law, but there's an opportunity to sort of grandfather under the sort of like pre-existing rules, in renewable energy, usually you see developers, they try and sort of grandfather under the rules that they know that they're more familiar with and there's more certainty around. And so they try to grandfather under those pre-existing rules. And then the new rules, in this case, the tech neutral rules, you'll see those sorts of like work their way into the market on a more delayed basis once all those grandfathered pre-tech neutral credit transactions are sort of work their way through the system.
And I don't want to go into deep a dive here, and this may be a subject of a future podcast. But when I think about the technology neutral definition with zero greenhouse gas emissions or less, the regulations, basically safe harbor certain types of technologies as meeting that test. And it strikes me that if you're safe harbored through the regulations, that's a quote safer technology to be pursuing going forward. Whereas if you're not part of the safe harbor, and safe harbor may be a better word, you can describe it differently if you would like, that there's risk associated with whether or not you meet the definition. And at some level, the concept of tech neutrality is, I understand the theoretical concept, but it seems like when the rubber hits the road, it can be challenging to underwrite. What's your assessment?
No, I completely agree with you. So like solar, wind, and battery storage, standalone battery storage, they sort of benefit from that safe harbor status, if you will, where they sort of will automatically meet the definition of tech neutral. And so I imagine that investors will favor those types of technologies. And so you'll probably see investors probably willing to pay more for credits generated by those already qualified tech neutral clean energy technologies.
So now let's talk now about portfolio size and given transactions. What are you seeing in terms of portfolio size? And a lot of tax incentive areas, there are certain minimum sizes to do certain types of transactions. There's a minimum size to really do a loan for the tax credit bond transaction. There's a certain minimum size to syndicate through a passive lease structure for historic tax credits, things of that nature. What are you seeing in terms of portfolio size? And do you have any thoughts on that, what that reveals in terms of what the minimum size a portfolio needs to be to go through a syndication structure?
Sure. So, when we talk about portfolio sizes, let me just add a little clarity on what I mean by portfolios, right? So when I use the term portfolio, what I'm really referring to is that the tax partnership, the sum of its renewable energy facilities is what I mean by the portfolio. So that portfolio is basically a sum of clean energy technology assets owned by the partnership that's going to generate the tax credits and related benefits. Okay. And so this really surprised me in terms of the size. Now, I'll give you the average size that we saw. The average CapEx per portfolio was around $225 million, which was definitely higher than what I was expecting to see before I started this analysis. Now, how much of that portfolio was financed with tax equity? On average, again, you get some sort of you get some variation here, but on average, approximately 38% of the total CapEx was financed with tax equity. And so, again, in terms of total CapEx, that number we're definitely seeing that number sort of rise every year as the industry continues to mature and grow. Now, we definitely had examples of portfolios that were noticeably lower than that, noticeably higher. So that it's important to note that just is the average. In terms of how big, we do get this question a lot from sort of new entrants into the marketplace. How big does a portfolio need to be to start to attract investors? We see portfolios that are obviously a lot smaller than 225 million per portfolio. So it's not like you have to have $200 million in CapEx to find a tax equity investor. You definitely can go a lot lower than that. But I think it also just gives an indication of, how we're really seeing some large system sizes being put onto the grid, which is fantastic to see.
So speaking of still being able to find investors at different sort of portfolio sizes, there's, in the loan to the tax credit space, historic tax credit space and the others, you have direct investors and you have syndicators. And there's various reasons for having syndicators versus the direct investors. And obviously the syndicators themselves or this intermediary, they either they'll go to multiple investors and basically syndicate across multiple investors, or sometimes syndicators will syndicate directly to an investor. And it's really a question is whether or not this direct investor want to have an in-house team that does the underwriting or outsource that to a third party, which oftentimes is a syndicator, so that they can outsource the underwriting and ongoing asset management, as well as they can get greater diversification with the same amount of investment dollars. What are you seeing in the renewable energy space, and how and to what extent Has there been change in 2024 or even sort of a change since the Inflation Reduction Act?
Yep. Great. So it's, in renewable energy, it's similar to what you see in low income housing and historics, where you've got a mix of direct investors and syndicators. And what we've seen since the IRA, we've definitely seen an increase in the number of total investors. In terms of how many of those investors are syndicators versus direct investors, based on the sample size that we analyzed, we saw what appears to be syndicators on over 80% of the transactions. However, in some of these situations, I'll just note that there are some syndicators that co-invest with an outside tax equity investor. So some syndicators, they're not just arranging equity dollars for a lower tier investment. The syndicator is actually coming in and also kind of co-investing. Now, when you look at that pool of syndicators that is known to co-invest, it gives the impression that the percentage of just pure syndicators that don't make any sort of meaningful investment in the transaction is closer to, say, 70%. And so in terms of direct investors that don't syndicate, you're talking about approximately 20% of the population. 70% are just pure syndicators. And then you've got this kind of what appears to be about 10% of the investors where they're syndicators, but they also actually co-invest.
And do you think, as a percentage of the market, do you think direct investors are about the same as they were before the Inflation Reduction Act, or do you think the percentage of direct investors is down a bit based upon the Inflation Reduction Act and the increase in the volume of credits?
You know, Great question. I mean, my perception is actually that we're seeing an increase in the number of direct investors. These are investors that I think they used to invest via a syndicator, but now they've either kind of ramped up their internal resources to be able to direct invest more on their own. And so, you know, we're seeing more just direct investors that were probably in the market previously, but going via a
Got it.
syndicator, but
Yep.
now they've kind of branched out on their own.
No, that makes sense. And then if that's the past, and if the past can predict the future at all, it probably means that that would sort of continue, and you'd expect to see a little bit more in the level of direct investors. I know we've talked before about the notion that even like with transferability, investors initially could buy a transferred credit and then in due course do a more direct equity investment and the like. But once again, subject for another podcast. When you do think about the market, and the market has increased dramatically in terms of the volume of transactions since the passage of the Inflation Reduction Act. So clearly more equity is getting raised. There's no question about that. The more interesting questions for me is, to what extent are the prior investors simply doing more volume, or to what extent are new investors entering the market, with the notion that if new investors are entering the market, they're likely going through syndicators as opposed to entering the market as a direct investor. What are you seeing there?
Yeah, you're right. So whenever because of the IRA and the option for industry participants to come in just as a transfer buyer, that's definitely helped to bring in a lot of new transaction participants. And we do sort of speculate that some of those will ultimately try to invest on a greater scale by becoming a partner in a partnership. And in terms of direct investors, we rarely ever see a direct investor enter the market without having gone through a syndicator first. That syndicator oftentimes provides some valuable services there to try to help educate, be a bit of a fiduciary, if you will, on behalf of the investor. And so it is rare to see a new entrant investor come in where they haven't already participated either as a tax credit buyer or invested as a partnership investor via a syndicator. And my expectation is that trend will continue.
I mean, and it's what we see in other tax credit spaces, as you know. So I'm going to ask you now the common, what I sometimes a little bit pejoratively refer to as the cocktail party conversation. And that's where you talk about tax credit pricing. And whenever I talk about tax credit pricing, and the reason I call it like a cocktail conversation is everybody wants to have a higher tax credit price. And we know that the tax credit price is a simple metric of equity for the credit. Doesn't take into account a variety of economic factors, like when you made the capital contribution, when you're getting the credits, risk level. There's so many, if tax loss ratios and things of that nature. So there's so many aspects to it that sometimes I jokingly say, I'll give you whatever credit price you want, as long as I get to decide, a variety of the other features of the transaction. I can make virtually any tax credit price work. So with the notion that whenever you talk about tax credit pricing, you're really talking about the price of oranges, apples, bananas, and all the rest. So they really don't cross compare very well because it's not a homogeneous good. But I can't help but ask that question. And obviously it does have some relevance to the extent various transaction structures are the same, but it definitely can be wide. You have to be careful. If a given developer, you might be getting a better price, even economically, even though the nominal price is lower. And similarly, an investor might be getting a better return, even though nominally the pricing is higher. With all of that to lay the groundwork, what can you tell us about tax?
Yeah.
Yeah. And undercut everything you're about to tell us.
Yeah, no, you did a great job of setting the table there on tax credit pricing, right? And as you pointed out, the pricing, oftentimes in the marketplace, people refer to how much the investor contributes to the partnership. They just kind of simplify that metric, that sort of like pricing as tax credit pricing. So the amount the investor is contributing to the partnership in exchange for the amount of tax credits they can expect to get back. Okay. But obviously the investor is getting back not just credits, but they're also getting back other benefits like tax depreciation benefits, some cash flow, et cetera. So, but they just kind of simplify the way they talk about pricing as a amount of equity contributed in exchange for credits they get back. So the analysis revealed average all in ITC pricing. So this isn't PTCs, this is ITC. Average all in ITC pricing for partnership investors, tax equity investors, of around $1.08 per credit, with fewer than 5% of that sample showing pricing under $1 and fewer than 5% over $1.20. And I'll just point out that's sort of the average for all partnership flip type of arrangements, but that the pricing for inverted lease investors was a bit lower overall when compared to partnership flips.
So yeah, thank you for that. And I won't add additional caveats since I gave all those caveats at the beginning. Very interesting. And I will say, if someone's listening to this podcast and they're not as new, or they're fairly new, to the tax credit space, you might be thinking to yourself, how can you pay more than $1 for a tax credit? And that's a question we get all the time when pricing is over $1 for various tax credits. And that's, of course, because of all the caveats I just mentioned. It's not just about the tax credit, it's also the tax losses and the cash flow associated with that. So you're really buying a bundle of rights and you're pricing it as if you're only getting one of those bundles. And obviously, the more valuable the losses are, the more valuable the cash flow is. You're going to sort of pay more. One other thing that I do find interesting within the renewable energy space, which you don't see as much in the historic tax credit or LIHTC or new market space, is the actual technology, the actual risk associated with the facility reflects itself in the equity pricing a lot more in the renewable energy space than it does in others. I presume you agree with that.
Absolutely. Yeah. So, your lesser sort of travel technologies that, investors are less familiar with, the investors usually require a higher rate of return for those technologies that they're less familiar with. Right. And sort of your tried and true technologies can oftentimes fetch sort of higher pricing from an investor.
And obviously that's a function of how much energy you can generate, how much income you can generate, how much cash flow you can distribute, and other sorts of risks associated with the comfort in the technology. So let's talk about tax credit transferability. That was something super new in the broader federal income tax concept, the notion of a federal tax credit being transferred. How has that affected investor equity pricing or investor pricing? I mean, I like to say technically a buyer is a participant in the transaction, not quote an equity investor,
right?
But they're transferring cash to the partnership to be able to claim the credit. So how has that affected investor pricing?
Yeah, no, this has been really helpful to me. When I look at a renewable energy tax equity financing, I really like to look at the amount the investor's putting in the deal, and I like to compare that to the various benefits they're getting back. And I try to analyze how much I perceive the investor, investing for each benefit stream.
Right.
Okay. Now, one thing that the tax credit transfer market has done is it's helped us kind of get a better sense as far as how much the investor values just the tax credits, right? Because we're seeing on these transfer transactions, again, we have an industry participant. They're not a partner in the partnership. They're not an owner in the facility. They're just an outside third party buying credits from the partnership that owns the facility. Anyway, the analysis reveals average ITC transfer pricing of approximately 92.5 cents per dollar of credit. I'll also note there wasn't really a lot of variability around that average. So, the highs and lows were also pretty close to that 92.5 cents. It wasn't like you had this kind of really big range. The pricing was kind of really in a tight box there that got you to sort of an average of 92.5 cents. And again, when I go back and I take that and I see that 92.5 cents per credit on the transfer deals, and then I kind of bring that back over to the partnership context, and it can help me better understand how much the depreciation benefits might be going for and the cash flow, et cetera. So,
And I'll give the caveat there. The 92.5 cents is obviously a function as to when you pay and when you receive the tax credit. And obviously there could be a notable sort of difference there.
indeed.
Let's turn now to the investor. And, in the local tax credit space, internal rate of return is a common way of looking at the investment yield. And basically an after-tax internal rate of return over 15 years. We all know from if you've had a finance class, that, IRRs can be deceptive. Net present value is a better metric. That being said, if you're comparing the same structures to the same types of structures, it can be useful as comparative. And the local tax credit market very much focuses on these after-tax internal rates of return. That being said, a lot of investors, even in LIHTC and the rest, might have their own rate of return models and things like that to try to evaluate different types of transactions. But IRR is the common way in which you would compare different funds and things of that nature. The IRR really, the flaws of the internal rate of return calculation really reveal themselves in structures like historic tax credits, renewable energy tax credits, and the like. Maybe not so much with production tax credits if they're compared the same transaction types to each other, but certainly with respect to ITC. So that isn't a methodology that is super useful. You can get some crazy internal rates of return calculations. So if you please share with the audience some of the common metrics that are used in renewable energy transaction and what your analysis showed roughly.
Great. Excellent. Yep. So as you said, right, so you could get a difference here with PTCs and ITCs. And so most of the transactions we work on here at the firm are ITC transactions. Okay. And you pointed out that with ITC transactions, sometimes the after-tax IRR can be a little bit deceiving or misleading, if you will, right? Because the after-tax IRR formula is very sensitive to the timing of when equity dollars are invested versus when credits come back. And you can have, small shifts in timing there. I'm talking like months, just a few single-digit months can have a dramatic impact on the after-tax IRR on an ITC transaction. And so because of that, investors have tried to find a metric that they can sort of use throughout the ITC renewable energy market to sort of better compare ITC investments so they can better kind of relate to what the deal is generating. And the metric that they've gravitated to is what's called an after-tax ROI or after-tax return on investment. What that means is you take the amount of money you look at the amount of money the investors contributed, and then you compare the amount that they've contributed to the aggregate amount of benefits they've got that they expect to get back on an after-tax basis. And you calculate the percentage of benefits in excess of what they contributed to the partnership. Okay. And, we could all debate what the most meaningful metric is to really evaluate the merits of the investment. However, the after-tax ROI has just turned out to be a sort of like a go-to metric for investors to evaluate ITC renewable energy transactions. Okay. Now, for the sample of deals that I analyzed in the last half of 2024, what that revealed as an average, again, this is just an average, but the average after tax ROI was around 19%. Okay. With less than 5% of those projecting an after tax ROI under 10% and fewer than 20% projecting an after tax ROI of over 25%. And again, just the average was around 19%. And there's all kinds of factors that go into what results in the deal having to offer a higher return versus a lower return and so forth. But just in terms of averages, 19%. Now, if we kind of pivot and talk about PTC deals, almost always PTC investors like to evaluate these investments on an after-tax IRR basis.
Yeah.
Okay.
Now that
Another,
Go
yeah.
ahead.
And one other metric I'll just point out, some investors like to refer to their return as, they call it a MOIC, which is MOIC, which stands for multiple of invested capital. What I've noticed is when those investors that evaluate deals on a MOIC basis, if you kind of look under the hood of how they do that calculation, it's the same way you do the calculation of an after-tax ROI. They just refer to it as a MOIC.
And I will say that the 19% seems like a pretty efficient market, given the fact that isn't a yield over a 1 year period of time. It's over a longer period of time, at least large portion, or at least significant portions of it. But when you're thinking about after-tax rate of return, please share with the audience some of the key factors that are driving it to be sort of higher or lower.
Yeah, right, exactly. So things like, there could be a variety of things. First and foremost, it could be the technology type. Okay. As you pointed out earlier, if you've got a technology that investors are less comfortable with, they might require a higher ROI. If you've got a technology that's more tried and true, or in a market that the investor better understands, if you have a well-known technology and a well-known market with a developer that they've got a lot of experience with and a deep track record, the returns to the investors can be lower because the investor perceives less risk. Okay. Now, if you have a smaller portfolio with lots of, a lot of small facilities in the portfolio in markets that are less known, maybe some technologies or component vendors that are less known, all these types of things can contribute to a higher required return. Other things that contribute to a higher return or lower return, the timing of when the investor is expected to get their benefits back. If they're investing, if the benefits are coming on a delayed basis, okay, they might want a higher return. If they're getting benefits sooner, that provides more certainty, then they can oftentimes be satisfied with a lower return.
And just to make it clear in terms of the timing, the after-tax return is basically saying, since this is not adjusted for time, there's no temporal adjustment. It's the aggregate benefits versus the amount you put in, and you put the money in. And if there's a longer period of time before you get your return, that number has to be a little bit higher so that you're getting a better annual rate of return on your investment.
That's right.
So Tony, this has been really interesting. So I appreciate you taking the time to pull the analysis together. And there's so much more we could be talking about that we can't get into this episode. Is there anything else you wanted to add before I move to the off mic section and bring it to a close?
Yeah. Look, if for the listeners that find this very interesting and they want to learn more about it, obviously reach out to me. We're also thinking about putting some of this information in some kind of report that might provide some additional insights and so forth. So that's still something that we're kind of toying around with. But there's, I think there's additional information that listeners might find valuable. Again, it's looking further under the hood in terms of how investors seem to be valuing the various benefit streams per structure. So I definitely encourage folks, if you find this interesting, reach out to me. I'd be happy to talk to you and more about, what other aspects of this analysis we're seeing.
I'll think of that, Tony. And for our audience, Tony's email is Tony, Tony .Grappone, Grappone @novoco.com. And I'll include his email address in the show notes. So you don't need to worry about writing it down. I'm sure if you just guessed how Tony Grappone sounds and said Novogradac, it probably brings you to him. Also, feel free to reach out to him on LinkedIn and connect with him there.
Mike,
please.
there's one thing I forgot to mention.
Yes.
Listeners, I encourage listeners to also reach out to me because I'm going to continue this analysis throughout 2025. If there are other data points about these deals that you value and you'd like me to consider as part of my future analysis, please reach out to me with those other data points you're interested in as well. I'd love to hear from you.
Excellent. I'd also encourage our audience to check out the rest of our Renewable Energy Tax Credit Finance series. You'll find it at novoco.com/podcast. You'll also find it on Apple Podcasts, Spotify, and on YouTube, of course. And I will include a link to the prior episode where we talked about the different transaction structures. Also on YouTube, we do have a dedicated playlist for our Renewable Energy Finance series. And it's a playlist that makes it easy to binge watch. So I'd encourage you to also share the podcast with others who might find it useful. I do know we have a number of clients that if someone is new to the firm or something of that nature, they'll just say one of their assignments will be binge watch these episodes. And as I like to say every week, if you have ideas or suggestions for future episodes, please email us at cpas@novoco.com. So now I would like to turn to our off-mic section. And this is a fun segment where we get to acknowledge our industry colleagues with shout outs. And this, I will give credit where credit is due. The idea of this did come from Tony Grappone. So Tony, who's your industry shout out this week?
Thanks, Mike. This week, I would like to give my industry shout out to, this is a diversity, equity, and inclusion shout out. And I would like to give the shout out to two of our Novogradac female colleagues who are doing great work in the areas of financial forecasting and prevailing wage and apprenticeship. I'm talking about Danielle Angelo, who's a manager with the firm and who has done a remarkable job with our PWA engagements. And then I'd also like to give a shout out to Carmen Awad, who continues to shine with our financial forecasting services. So if you need help with prevailing wage and apprenticeship assistance or financial forecasting, I'd encourage you to reach out to them or reach out to me and I can help get you connected with them.
Great. Thank you for that, Tony. And I echo the shout out to Danielle and Carmen. Thanks for the great work that the service you're providing to Novogradac clients. So thank you, Tony. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.